Well, welcome back to the Kansas City Commercial Real Estate Market Pulse, sponsored by Exchange Commercial Real Estate. I believe this is episode 10 that we have gone through the last 6 months or so, interviewing special guests and bringing our market updates, as well as bringing all of the information that we are looking to provide to our clientels. And one of my favorite pieces of being able to do these shows on a regular basis is not just hearing from the speaking head of Logan Freeman, but the most highly watched and attended shows have been with our special guests. But if you haven't followed us before, this is your first time. The introduction to the Kansas City Market Pulse is simply that. I saw a niche and a need in the marketplace for up-to-date commercial real estate and real estate investing advice, as well as updates on the markets that we're involved in. And everything that I was researching typically was looking through the rear view mirror and not necessarily the windshield. And what we're doing here on a bi-weekly basis, simply bringing you valuable up-to-date information on the commercial real estate market. And before I introduce our guests here today, one of the things that we're always doing is figuring out and prognosticating about what the future holds. And we'll be doing a little bit of that today based on historical data and market cyclical analysis. Before we do that, and before I introduce our special guest, this is our team here in Kansas City. That's me, Logan, the managing broker and director here at Exchange Commercial Real Estate. If you've done any transactions or work with us, you have run into Katie Cobb, who does all of our operations, and there's our brokerage team. So anything in regards to commercial real estate, multifamily, retail, industrial, office, and land, we are involved with here in Kansas City. So please do get in contact with us. If you have a property you're looking to sell or you're looking to invest in the market, we can definitely help you do that. Without further ado, I want to, and I'm very excited to introduce Akhil Patel, who's a leading expert on the 18.6-year real estate cycle and the author of The Secret Wealth Advantage. Akhil's insights helped myself, as well as numerous investors, navigate the ups and downs of the markets like a pro. And what we're going to talk about today is the 18.6-year real estate cycle, which I have found to be an incredibly powerful tool that can help to map out predictable boom and busts in real estate. I always say that knowledge alone is not power. Knowledge plus action is power, but it does start with knowledge. And what we're going to talk about today will give you the confidence to take action. So excited for you to join us today as we dive into how you can use this powerful tool to anticipate market shifts and make smarter investment decisions. Akhil, how are you doing today? And how are you just in general right now?
I am very well, Logan. Thank you so much for having me on your show. It's good. I'm based in London, as maybe you know, and as your
Yes.
viewers know. So it's just turned into kind of winter. The clocks have gone back. It's dark at sort of about 4 p.m, but that means that Halloween and then Christmas is just around the corner. So
Yes, it
it's
is.
a good time of the year.
Well, it's always interesting to hear, folks' origin stories. I know your origin story because I've read your book and listened to numerous
Yeah.
shows that you have shared that on. But it's always funny because not just in the commercial real estate space, but I think a lot of people sort of stumble on how they got involved in doing what they're doing now. So what is that story, just quickly, and what are you doing now?
Yeah, so I did indeed stumble on this kind of research and this analysis and what I do with it for my subscribers, which I'll come on to in a second. But really, it goes back to just before the financial crisis. It was a really good time for entrepreneurs and business owners, and well, actually anyone who was active in the markets. And that included my family's business. We are in pharmaceutical wholesaling. It's a very simple business model. You borrow a bunch of money from the banks, you buy some pharmaceuticals, you sell them to independent pharmacies, you repay the loan, and you do the thing over and over again.
Yep.
Well, that model works very well, and it should work during a recession because people don't stop getting ill. The problem is that it's also reliant on bank credit, bank finance, and when banks are stopping lending to small businesses, it really can cause a massive problem unless you have a lot of cash on your balance sheet. It caused us a lot of trouble, and I thought to myself, I can't believe that we were so unprepared for this episode, and that I would be, I'd work with my family and with other people to figure out what went on, and be prepared for the next one, because it seemed to me that these things move in cycles or waves or whatever it is, and they happen over and over. And one of the reasons why I twigged onto that very quickly was I remember the early 90s recession, which had many similar characteristics. It had been preceded by a real estate boom in the 80s,
Mm-hmm.
and there was a sort of major recession, and it was a pretty difficult time for my family. The business went through trouble then, and I sort of asked myself, why is no one obviously putting the two episodes together?
Yeah.
And so I thought there's something to this cyclicality. I'm going to find out what it is. I'm going to use that knowledge in a practical sense so that next time we'd be prepared. And that's kind of how I got into kind of researching cycles. And eventually I met some people along the way that, in fact, kind of opened my eyes to the world as I see it now. And we've sort of gone into business together, and we provide the benefit of our research in a practical sense for people who want to know how the system works and what they can do about it to benefit themselves and their families.
Well, I find that there's always a story behind what drives people, and I appreciate you sharing that and going through that pain. That obviously is a big motivator to figure that out. And your story, and I wanted to share this with you, has always reminded me of reading Ray Dalio's books, and when he was a stock market trader and going down and to the stock market when the gold standard was ended, and he thought that the world was going to end and the stock market was going to crash. And what did it do? It went ballistic. It went crazy, right? And said, he sat down and basically said, surely this isn't the first time this has happened, and I need to figure out why. And he started his whole path of understanding cycles. And so I don't know if you knew that story or not, but it is one that is a common theme for me to try to understand. And one of my favorite quotes, I believe, is attributed to Mark Twain, which just simply says, history doesn't always repeat itself, but it often rhymes. Right.
Yeah.
And that gets me really interested and excited to try to understand, because I have not lived through all of those cycles. And it is my job to understand what the macroeconomic landscape can provide for me in regards to details and data to be able to help people think through difficult times, which surely we have gone through recently and potentially have that in the near future here as well. So thank you for sharing that story.
Oh, you're quite welcome. And thank you for comparing me to Ray Dalio.
Absolutely. I've got all of his books and yours, which we're going to talk about now, on my bookshelf behind me. So, Akhil, you wrote The Secret Wealth Advantage, and candidly, I read Phil Anderson's work, The Secret Bank of Real Estate and Banking, beforehand, and found that to be quite eye-opening, but somewhat of a dense read, and that's great. It really is. I like the textbook style and a lot of data and history and backing it up. I totally understand that perspective, but I really understood. I really resonated with your book in a lot of different ways. So I wanted to ask you if you could just give a brief overview of your book. I've got tons of data and notes that I want to ask you about on this specifically. But what inspired you to necessarily write The Secret Wealth Advantage, and how that aligns with your views on the land cycle?
Yeah, so I mean, just for those of your audience who haven't read Phil's book, The Secret Life of Real Estate and Banking, he basically documents the 18-year real estate cycle. I call it the economic cycle because it really affects the entire economy.
Sure.
He documents that from essentially the founding of the United States when it sort of really got going in 1800, all the way to 2008, 2010. And he kind of tells US history from that lens, and he does a very good job, I think, in showing how, when you kind of know what you're looking for, you can see the repeat of history in a way that really affects business owners and investors and so on.
Sure.
What I try to do with my book is I try to distill a lot of the insights that come out of the kind of repeat of history and kind of turn it around and say, right, here is the framework. Here is kind of what happens each stage. And I use each kind of stage, I illustrate it with a different episode from history. Here is what you need to look out for when you're in that stage. And here's what to do about it practically from an investing point of view. And so actually it's a distillation of what's in Phil's book. It's also a distillation of some of the other great kind of cycles analysts of people who've come to discover and understand the cycle. So people like Fred Harrison, Fred Folvari, who's unfortunately not with us, Mason Gaffney, also not with us. And going back further, Roy Wenslick, a real estate guy out of Missouri in the 1940s and 50s. And before that, Homer Hoyt, who wrote a thesis about the 18-year cycle in Chicago, studying land prices in Chicago, going back to the founding of Chicago, and he published his work in 1933. So there's a lot of kind of analysis and research. I wanted to distill that. I also wanted to really explain why the cycle happens and why no one sees it. So I delve a little bit into kind of what I regard as the fundamental law of economics, the law of economic rent. I also kind of try and explain in relatively simple terms, but in a way that gives people access to the underlying principles, how kind of money is created and how the banking system works. So that obviously is very connected to real estate and to kind of the land cycle. And I structure the book as a journey through the cycle. So at each stage, you get the next sort of kind of episode of the cycle. In between each stage, I try to give people a bit more knowledge about what's going on and why it's happening. So I have sort of chapters in between each stage that explain the cycle and explain why no one sees it. And so as you go through it, hopefully you're building your understanding of the cycle, but you're also building your understanding of how the system works, which is essentially how I came to kind of write it. And quite interestingly, just as an aside, it's probably not so relevant to the audience watching today. It took me a long time to work out the structure for the book. Because, you know, I started by thinking maybe I should do a little bit of a potted history of 3 or 4 cycles just so people can see the repeat and then distill the lessons and so on. And a publisher told me, well, that's probably not going to work. It might, you know, people want to skip the beginning bits just to get to the lessons and so on. So I was actually watching The Last Dance, that sort of documentary about the last season of the Chicago Bulls.
Yeah.
And that's basically the story of the season told sequentially, but every so often they depart from the sequence of what's going on to explain how the team got together and how the characters are and how they interact. And so essentially my book is a bit like that. It's a journey through the cycle, but then you leave the cycle momentarily at different stages to understand what's going on, why it's happening, and so on. So it took me a while to get there, but that's kind of the inspiration behind the structure.
Well, I'm very glad that you did, because that structure is a very easy read and it's a fun journey to go through, and I highly recommend it. A couple things I just wanted to point out to you was, and to the audience, was in chapter 2 you talk about understanding cycles, and you emphasize the fact that, and everybody asks me, what is the secret to X? What is the secret to Y, right? Well, you said, look, the secret hiding in plain sight. Owners are deprived of the knowledge that would have saved them from the cyclical pitfalls in the capitalistic economy. And that highlights, I think, how understanding the cycle can prevent major losses if you know where you're at and what's coming in the future. Moving on to chapter 10, understanding the boom and the bust. You discuss how to leverage the boom phase for maximum gain. And you stated that, you know, experts did not and still do not see these crises coming. And no one needs to fall victim to the next crash. And wow, do I think that is widely accepted in the industry and in just the media is. And that's why I follow. So please, if you haven't picked up the book, here's the link to go pick up the book. I have the physical version and I have the Audible version, which I love to utilize on a regular basis. But we all see, you know, everything's fine in the media, right? Everything's fine. And we have a lot of, I won't call it propaganda, but we have a lot of media that is saying the positive things, right? And, you know, frankly, we're going to talk about the differences between the 2008 real estate cycle and where we're at today later in the show here. But the point being is not very many people saw that coming. Everything was fine up until it wasn't. And then finally, you know, in chapter 11, you go into practical tips, which is what I was wanting and needing, right? And that's providing actionable advice on positioning investments during different cycle stages, which is helping investors anticipate periods of market volatility. And you intertwine those in every single phase of the journey as well, which is extremely helpful and insightful. So the structure that you have written this book in and the insights to me is this is a highly recommended and suggested book for me. I have tagged you, and I have put a lot of people in your direction to go purchase this book. So just first off, just great
Thank you very much.
in writing this book.
Thank you. Thank you. I'm glad it's been of use. And look, I think I should say probably at the outset of our discussion is that, you know, in some ways it doesn't really matter if I'm right or not. I mean, obviously it's better if I am, but the reality is that when you're making an investment decision, it's always going to be about the investment proposition that's in front of you. And, you know, obviously the cycle is a very important piece of context, but it's not the only thing. And the investment is going to have certain characteristics, some of which are good and some of which are bad. What I think this framework really helps you, regardless of whether it's right or not, is to think that there is a bigger picture, that there are phases of the cycle, that, you know, that good times don't last forever and equally bad times don't last forever. And I think it gives you an additional perspective to have thought, you know, more fully about, you know, the context in which an investment is taking place. Now, I happen to think that I'm I have good reasons to be correct, because the cycle has been going on for many hundreds of years in the US, and the UK doesn't repeat exactly, otherwise everyone would see it. But there is enough commonality that you can take advantage of that historical insight, which is what I try to give people.
Well, I think that's a great segue into the meat and the potato of today's discussion. And if there was to be, if you have an iPhone, it tells you, and maybe Androids or Google phones and all those do that now, it tells you where you spend your time on your phone, right? I don't think I've seen where it shows me how long you have looked at one picture, because I have this saved on my phone. But I have spent hours and hours and hours looking at this and prognosticating about this. So here it is. This is, to me, the chart of all charts. So why don't you give us a little bit of backstory on when you created this, the history of this cycle, and then we'll get into a brief overview of the economic cycle itself.
Yeah, so I mean, firstly, kind of just the basic structure of the cycle, which is what this diagram kind of represents. It's essentially an 18 and a half year cycle, which has, you know, essentially two main components. One is kind of an expansion of about 14 or so years, and then a crisis and crash, which lasts about 4 years. And that itself can be subdivided into further kind of subsections. So the 14 years up is itself two halves of approximately 7 years each, interrupted by a mid-cycle slowdown or recession, which is a relatively sharp but short recession. And, you know, economies tend to recover a bit more quickly than other recessions out of it. You then have the second 7-year expansion. The final 2 years tend to be characterized by much more speculation and frenetic activity, and things go way over the top, and you get to a peak. Now, the peaking process may last a bit of time itself. It's not always kind of one day it's the peak and then it's the crisis. It can sometimes be a phase in time,
Sure.
but nonetheless, you have a peak and then the whole thing comes crashing down. And when it comes crashing down at the end of the cycle, it brings down the banking system. The real estate market typically comes down very hard, is very reliant on bank credit. Businesses also reliant on bank credit collapse. That creates a lot of unemployment and a lot of misery and so on. The whole system needs bailing out in some ways. And that whole process, unlike the mid-cycle recession, takes several years to really sort out before the next cycle can take place. I actually didn't invent this diagram myself. I sort of refined it. This isn't actually something that I did. It's based on an image that I created back in 2014. But that itself was based on something that created by Fred Harrison, who's an English economist who was probably the person in the late 70s, early 80s who rediscovered the 18-year cycle, and is actually the reason why I've been able to do the work that I've been able to, and same with my business partner, Phil Anderson. What I've done with this is I have kind of, I think, more clearly delineated the different phases. And there's an image that I send to subscribers every year. It's basically this image. I put a yellow dot on it, and I put a few different sort of characteristics of each phase on it. And all I've done, having created that sort of image back in 2016, is just to move the yellow dot along each year. I mean, the other things that were on it, like sort of Brexit in 2019, the
Mhm.
mid-cycle recession shortly after that, um, the huge boom in infrastructure spending, which followed COVID, which is always characteristic of the second half of the cycle. Um, the era of easy money, by which I mean much more expansive bank lending. Now, not for everything, but certainly a stance you see in the second half of the cycle, because banks tend to survive the mid-cycle recession in pretty good shape. Um, the acceleration in commodity prices, we haven't seen it across the board, but in certain commodities that certainly happened after 2021. The development of super tall buildings and so on. All of these things that I document in the book, which people who study the cycle kind of understand the sequence of it, I've put on, and it's sort of been pretty, I think, if I may say so humbly, fairly accurate, despite it being a relatively basic kind of framework in which to kind of view what's going on. And so I think that speaks to the longevity and the enduring nature of the cycle, and you can sort of capture it in a relatively simple image like this.
Yes, it gives you a framework to actually respond to, and like you mentioned, even if you are not, and this is not correct, it still gives you a framework to be thinking about. And I
Yeah,
have
exactly.
utilized this not only on the investment side, but on the brokerage side, talking with property owners and utilizing this type of data and insights to help make decisions. And it has been widely helpful because not many people in my industry specifically are utilizing these types of resources. That being said, when I look at this, and one thing I think about relatively often is that mid-cycle slowdown. And obviously in 2020, we know that the global pandemic happened, right? But that was not. There's no way to forecast a pandemic. Okay, so the question that I get a lot is, well, that mid-cycle slowdown was caused by COVID and the pandemic, and the answer that I typically get is it exacerbated a lot of things. And I wanted to ask you specifically around, if we started in 2011, 2012 on that first
Yeah,
expansion phase, do
yeah.
you believe that that mid-cycle slowdown was just exacerbated by the pandemic? Was there still something, there signs that were happening that there was going to be a slowdown?
Yeah, I mean, so again, I didn't create this particular graph. I would actually put the mid-cycle kind of number there as 2019,
Okay.
maybe even 2018, but there was certainly a slowdown taking place in 2019.
Hmm.
There was a sort of, you often get the slowdown induced by interest rate rises at that particular phase of the cycle. Jerome Powell was doing that in 2019. He got told
Yes.
off by Trump on Twitter, as people often do, and there was a kind of a blow up in the repo market and other things. There was some trouble, but we were certainly experiencing a slowing global economy, and I mean, some of that was, itself exacerbated by kind of trade wars and other things. But it was also a sign that there were, it was, around the time when things had been expanding for a number of years. And there was a slowdown in the kind of flow of things going into investments and so on. We had an inverted yield curve, though it was sort of a bit mixed, and some of the signals have been a little mixed because of the enormous intervention that central banks and others have made in bond markets and in the economies in general this cycle.
Sure.
It's characteristic of this cycle. You could argue in a sense that COVID ended the mid-cycle recession, because
Yeah.
the amount of stimulus that was put into the global economy was actually far and above more than really needed to be done. Um, Interest rates didn't really not need to go down to 0%, and that created all sorts of trouble. Um, well, it created a bit of a good couple of years, and then it caused all sorts of troubles as the sort of bill came due.
Akil,
Uh,
as I was doing some research, I found that, and I had heard this statistic, but the fact that 80% of all United States currency was put into circulation in a 12 to 15 month period. And that is substantial from the standpoint of the trillions of dollars that was injected. So if we're following along
hmm.
this 18-year real estate cycle, and there we are, and we have our mid-cycle slowdown. I mean, and then boom, 80% of all United States currency is injected into the economy. Wow, yes, that would make sense for a second expansion phase, which we have seen. And I like to actually overlay this framework with the Green Street Property Price Index because I it's right, it's widely available to me, and it's really interesting to see the similarities to that. And what I will
Mhm.
say is, in that period of time, we hockey sticked, right? The indices, I think, peaked at 155 and we are all the way back down to 125 right now, which is similar to pre-pandemic levels on the Green Street Property Price Index. And so as I overlay that with the 18-year real estate cycle and this economic cycle, it all starts to make a little bit more sense to me.
Is that so? The Green Street Property Price Index, is that a commercial property or everything?
It is commercial property, and
Okay,
I
yeah.
do not believe it takes into consideration land.
Yeah. Okay. No, I mean, look, the reality is that this is a very simple framework. It's not going to give you precisely how everything's going to move in relation to every asset class, and it doesn't necessarily account for the fact that you can have this enormous money printing machine taking place in such a short space of time, and interest rates being zero, and everyone around the world doing somewhat similar things, at least in the kind of G7 countries.
Right.
And also at the same time, when you reopen the global economy being sort of fairly different, at least in the short term, to the economy that closed down before it. And so you had this sort of absolute record level of savings, and people who wanted to spend money at a time when, as the global economy reopened, they didn't have the ability to get things as they used to be able to get. And, some businesses had kind of fallen over and there was less competition in the marketplace. Businesses had pricing power. And inflation was the result of that. And then we had the Ukraine thing. So there were a number of kind of factors. And then Jerome Powell sort of panicking, having thought inflation would be transitory, going sort of berserk in terms of raising rates at the speed that he did. I mean, that's clearly going to have an effect. Um, I think I think there's two things I'd say in relation to real estate. The first is that you know if you were to ask anyone sort of 1 month before the first interest rate rise back in the start of 2022, you ask them it's going to be 5% in a very short space of time. What's residential real estate going to do? I mean, they would have told you it would collapse.
Right.
And it sort of did come down, but it didn't come down for very long. I think it didn't come down much, and it didn't. It was probably about 6 or 7 months, depending on where you were. Now, real estate is a locational asset; doesn't mean that everything is going to be resilient and so on. But real estate's in the best locations. Commercial real estate much more sensitive to interest rates. Sorry, I should say, by the way, we've done a bit of research. We've put it out there that every time the Federal Reserve raises rates, property prices go up. So this idea that it moves inversely is not correct. Over a course of each tightening cycle, actually, residential real estate prices went up. Um, and I don't know how far prices went back up after the low in early 2023, but I suspect that prices were still a bit higher than they were. Um, well, maybe not higher, but they're roughly in the same place as they were at the start of 2022, having recovered somewhat when the final sort of just before the Federal Reserve started cutting rates again. Commercial real estate slightly different. Lots of different asset classes, all kind of move slightly differently in relation to economic growth and what people are doing and new businesses and that sort of thing. And yes, indeed, we have seen some real trouble in that part of the market, partly exacerbated by two things. One is that people don't know how we're working, what the sort of new office is going to be like and all that sort of thing, and where offices are going to be. And the second thing is that, let's face it, many businesses around the country, whether they're banks or real estate developers or other things, had just got far too used to 0% interest rates, had not managed any kind of risk of that sort of not happening indefinitely, had speculated on various things. So I'm talking now about apartment building in locations where maybe the demand wasn't really sufficient to meet the supply that was coming on, and have been in trouble. That is unfortunately the cycle doesn't dictate when people are smart or silly about investment decision making. And I think some of that is washed out in the commercial real estate market in the last
Yes.
sort of 18 months.
Absolutely, and I'm so glad that you mentioned the interest rate work that you have done, because I have long been a proponent of reading and studying Dr. Peter Linneman's work, who was at the Wharton School of Business as their chief economist on the real estate side, and his book is utilized. The real estate financing book is utilized in Blackstone and most large private equity groups. And that being said, they put out research probably 6 or 7 years ago that said if interest rates and cap rates are correlated, where is the resource, where is the data to back that up? And while they might be somewhat directly correlated, what they found was that capital inflows, so a percentage of mortgage debt to the GDP ratio, has a much larger impact on cap rates than, which is capitalization rate, if you're not in commercial real estate or just in real estate in general, has much more impact on cap rates than interest rates alone. And that is exactly what we are seeing in today's market, in my opinion. So I'm so glad that you mentioned that and you shared that, because so many times I'll see, well, interest rates are going up, property prices are going to go down, and that's just not true across a lot of data and history, honestly. And it's very specific to the asset class that we're talking about. So thank you for sharing that. I think that the question that is on everybody's mind, and that I got repeatedly, was, Logan, in this framework, on this chart here in the cycle, where are we, and where do we believe we are currently in the 18.6-year real estate cycle?
Yeah, so 2020, 2021, I think 2020 was the end of the mid-cycle. So you just move that dot along. So we're kind of approaching what might be called, I call it the mania phase of the cycle, but here it's called the winner's curse. So we're around 2 years from the peak. So in many areas, you should be seeing an acceleration of prices, but even if not prices necessarily all at the same time, investment flows and speculative activity and people buying, not so much on sort of fundamentals, but on kind of the prospect of kind of growth tomorrow to justify the investment decision. Now, I appreciate, again, it's not all asset classes all at the same time, but
Right.
The reality of where we've been over the last 18 to 20 months is that at the start of last year, everyone was absolutely certain we were going to have a recession, which we didn't. And everyone was certain that the stock market would sort of have a much more significant downturn. Everyone was certain that the Silicon Valley thing was the sort of first domino to fall, and that'd be sort of financial contagion, and so on. And the reason why none of those things happened was because of where we are in the cycle. So it's a particular type of phase of the cycle when you have enough kind of fear and problems in the cycle, in the economy, related to banks really struggling to kind of shore up their lending at the same time as the stock market and the property market and other asset classes coming down, which reduces people's balance sheet wealth and so on. That's a particular phase of the cycle which we haven't seen yet, and that is why it's kind of, while there have been problems in certain parts of the economy, there's no question about that. It hasn't been the general economy-wide panic that you would expect to see at the end of the cycle, and that was what people were certain was going to happen at the start of last year, and it didn't, because of where we were.
This mania phase is highly interesting to me on many different fronts. If I correlate that to where we are in regards to property prices and what's happening on a level of where the banking system is, and where I'm having anecdotal conversations about capital inflows and all of that, it would make sense to me that the last, what I'll call freeze of the last 16 to 18 months, because if you're in commercial real estate, if you're in real estate investing, in a lot of ways, nothing has happened. I mean, transaction volume,
absolutely.
transaction volumes at 10-year lows. I mean, and so we are starting to really start to see picking up of transaction
Yeah.
activity and prices going back up. And so that was just almost gives me the goosebumps to look at this and then figure out what I'm seeing on a regular basis with my clients
Yeah.
and in my markets and say, yeah, I mean, people are like, there's no way real estate can go back up. And we have John Gray at Blackstone, we have KKR, we have all these people. They were calling the bottom of the real estate market, and here's where I think there needs to be some clarification. They called the bottom of the phase of the cycle that we are currently in, not of the real estate market. Because if you look at the Green Street Property Price Index, yes, we did trough back down to 125. That was the bottom of this specific phase of
Yeah.
the 18-year economic cycle, which gets lost on people, Akhil. And that's
That's
the
true.
big component that I try to educate on.
Yeah, absolutely. Look, and I mean, I'd be interested, by the way, just to know what, which segments of the commercial real estate market you're seeing are picking up. But just let's set that aside for a while. Yeah, I mean, you're absolutely right. Every asset class, and real estate in particular, both on the residential and on the sort of commercial side, have specific phases related to what's going on in a particular location in terms of interest and supply and demand and all that kind of stuff, right? And oversupply, etc. And then people get priced out and they move somewhere else, they move to adjacent areas, and the whole thing kind of ripples out. Those are cyclical. Well, people call them the cycle. In some ways the terminology doesn't matter, but they're going on all the time. And if you were an investor in 2011 to 2019, you would have had that in different locations and different sort of ways and different phases. That happens all the time. I think what this gives you is the bigger picture when it all
Yes.
goes south at a particular phase of the market, when you tend to get the most kind of speculative, kind of feverish activity. It doesn't mean that, I mean, commercial real estate investors probably got quite burned when interest rates went up very significantly, and may not get to that sort of that state of going all in, and maybe interest rates won't be particularly low even if they are cut. And so that asset class might have certain characteristics depending on how it got there. One thing I would say though is that seems to be a feature of every cycle that commercial real estate, and again, I appreciate I'm using that term very broadly, commercial real estate tends to peak after residential real estate.
Yes.
And so what you might find is that you have this sort of pickup now as of middle of, well, it's not middle of 2024 now, but I think things were turning around then, and it may extend beyond 2026. And you actually got something similar in 2008. So residential real estate in the US, in the most kind of speculative areas, peaked, I think, if I'm not mistaken, sometime in 2006. Maybe in some areas 2005, some areas early 2007. I don't know. US is a very big market, but commercial kind of construction activity and commercial real estate benefited from the outflows from residential real estate for a couple of years, and actually probably peaked after the peak of the cycle. But maybe the economy is already starting to go into recession when some areas of the commercial real estate market peaked. So you could quite well see something similar happening over the course of the next sort of 2, 3, 4 years. Again, it's not going to predict absolutely everything that happens with every asset class, but it gives you a framework in which to kind of consider some of these big decisions that people are making.
Yeah, absolutely. And let's talk about some of the signs. As a subscriber myself, when I subscribe to Property Share Market Economics, not only do I get the monthly newsletters, but I'm also getting a lot of work that was done previous. And one of those documents talked about being able to understand when you are at the bottom of the real estate cycle, which is an indicator in your book as well, which is when the stock market starts to make higher lows. We may feel like we're moving up. That's great information for people that are looking
Yeah.
to position themselves. The question that I think that many people have is, how do we know, or what signs can we look for to know we're at the top or nearing the top of the real estate cycle before we start to maybe move downwards, right? I think that's the signs that
Yeah.
we're trying to get to.
Yeah, so I mean, we're talking from a broad cyclical perspective. Again, I'm not necessarily referring specifically to commercial real estate, but just based on what I've
Yep.
said, commercial real estate might well be doing quite well, but you would start to see that residential home builders are, not doing quite as well. Now, I know there's been some earnings kind of news about some home builders, but it's not yet kind of a trend, I don't think. You're starting to see a slight bifurcation in the economy. You tend to find that the broader stock index is going up, but the price of home builders is going down, is trending downwards. That is actually a warning sign that the peak is coming. You're seeing a lot of extravagant behavior, a lot of crazy construction. I think we have to look more globally now because it's a global boom, but you're seeing
Mm.
really kind of major projects in places that you wouldn't expect, like Oklahoma City, and so maybe Kansas has got stuff going on downtown. This is the sign.
Akil, pause there. Check this out. We're getting live questions, and this plays into exactly what you're talking about right now. Is commenting on the phenomenon that we see leak in the trough of the cycle with tall buildings emerging. Right, the tallest
That's
building in
exactly right.
Oklahoma City. So I just wanted to showcase
Yeah,
that we have live
and
listeners listening in.
that's right. And actually, I mean, it's a good comment. They do open at the bottom of the cycle, and the reason is because there's a construction lag, of course, and the valuation of that building, or the premise or the business case of that building, is renting out kind of space at a certain level. And when you have the recession, you have a delay because probably financiers collapse or withdraw and so on, and so then they have to find someone
Mm.
else. um, and so it takes some time to actually open, and then it ends up being empty for a number of years because you can't possibly get tenants in who are paying less than you imagined at the start. Otherwise, you owe more than the value of the building, etc. So yeah, a lot of problems associated with that, but very much linked to kind of how the cycle operates.
Absolutely. And that is something that I found to be really interesting is watching. And by the way, I'm not shamelessly plugging, I am plugging Property Share Market Economics because they go out and scour the internet and the media for the signs, and then they send those signs to me in my inbox so I don't have to look at it. And we've seen
Yeah,
it all across, right? And we were talking about Asia. We're talking about because it is global now, and that's a global cycle that we have to be aware of. And this
yeah.
just the insights that are provided make it so much easier for me to try to understand this macro picture and a global picture. So please do go and subscribe to that, and we'll have all the links for that here in a second.
Brilliant.
Okay, 1 second, or sorry, one what, and I'm quickly finding that this is probably going to have to be a part. We're going to have a part two because
Part two. Yeah,
we're not even
spicy.
getting close to Ricardo's economic law of rent and law of
Yeah,
economic rent, but we
yeah,
we may get into it. But furthering on the chart
yeah.
in the framework that we just discussed, maybe help our listeners understand what we're looking at here with this real estate clock. And I think I do believe if I get on the website, this is free, so go to propertysharemarketeconomics.com. You're suggesting that we're in the hour of 14 here of this clock, which means the real estate cycle is in full swing and there's lavish government spending for public work, correct? So this is another framework that has helped me understand this in a different visual way, but
Yeah.
would love for you to comment on that.
Yeah, so this comes directly from Phil's book, The Secret Life of Real Estate and Banking, and it sort of has, I mean, it's a 24-hour real estate clock overlaid on an 18-year cycle, so the numbers are slightly awkward, but the inner circle is the kind of first half of the cycle, the outer circle is the second half, and the kind of leading into the crisis. And you can basically, he's overlaid some of the signs. I set it out in my book, kind of chapter by chapter. He's done it around the clock. He's derived the sort of indicators from prior research, both his own research, but also the research of people like Homer Hoyt. Um, and yeah, one of the things that powers the second half of the cycle, so on the clock, it's sort of hour 13 onwards, is that one of the kind of responses to the mid-cycle recession is huge kind of public expenditure on infrastructure, and so on, partly because that's a way to stimulate and inflate an economy, but actually also I think it's got something to do with the fact that as I say in my book, one of the things that delineates one cycle from another is that it often starts with a novel new technology or
Mm.
new way of doing business. And so in my view, kind of attributed the start of the current cycle to the iPhone and all the sort of enormous possibilities that kind of created. It's not the only thing that's going on, but that really, I think, for me, was a game changer, and kind of 4G, wireless standard as well. So fast internet on your very powerful mobile phone computer. And I think that what you tend to get as you get to this mid-cycle recession, you get all this sort of desire to spend on infrastructure, is you basically a recognition that the economy needs to be fit for purpose for the new era. And so we had enormous spending on infrastructure out of the COVID mid-cycle. So it was not just about iPhones; it was about the green energy transition. It's about renewing kind of roads and rails and ports and all that sort of thing. There's a new fashion for making sure that manufacturing is a bit closer to home, because supply chains are vulnerable to kind of shocks like COVID, and vulnerable to trade wars and new form of geopolitics. So you tend to find all of that coalesces around the second half of the cycle. It really pushes activity. There's a lot of activity. It pushes land prices up. It shifts where businesses locate and where people locate, and that creates itself the grounds for economic growth. And so we have seen all of that, and both of the candidates in the current US election are talking up the amount of investment they're going to do as a result of getting elected. It's I'm not making a comment on whether that's a good or a bad thing, but no one's really saying, oh, well, we've got to stop spending and we've got to reduce the deficit. They're in fact saying the opposite. Even in the UK, which is not in quite the same kind of situation as the US, we had a chancellor today making a statement about the budget for the next year. And while there have been some tax rises, all about investing in the economy and AI and the health service and other things. We had Mario Draghi, who used to be the central banker for the EU, who famously said in 2012 he'd do whatever it took to save the euro. He did a report just a couple of months ago about how the EU needs to spend trillions of dollars in investment on infrastructure and making it fit for purpose and competitive with the US and with China. So it's very much of the current sort of period that you can talk about these really big kind of schemes and ideas for investment. And that's always characteristic of the second half of the cycle.
Absolutely. Well put. And I would say that being around, hour 14 here with the lavish government spending, the Treasury announced its marketable borrowing estimates this week for the United States, which the projected financing is $546 billion in Q4 of this year and $823 billion during Q1 of 2025. And so that is not going down by any means. And also the other trend. So first off, would love, before I move on to the second trend that I've been following, is the federal funds rate being reduced in the United States, but the 10-year Treasury rising from 362 to 427. And I think there has some implications when the budget is 546 billion for one quarter and 823 billion for next quarter. And so your thoughts on that in the United States, and any further recommendations on what we should be thinking about because of that.
Yeah, I have to say, I don't fully understand what's going on in the bond market. I mean, I read somewhere that it's the market potentially pricing in a Trump presidency, in the sense that if it was Kamala Harris to win, it would be a sort of a divided Congress, and then whatever she wanted to do wouldn't really get done. And so the market would need to react. Whereas, if Trump wins, it's also possible that he would have a Republican Congress to basically do his bidding. So
Sure.
so that would mean a much higher deficit, and all the rest of it. And therefore, the bond market is kind of pricing in the fact that you will get growth, but also you'll get sort of a return of inflation. I don't know if enough about it to really kind of know if that's a trend, or if it's just a temporary kind of reaction to some news, and actually it might sort of change over the next few weeks. My expectation is that the dollar would weaken over time, and I still believe that. But the dollar has strengthened over the last sort of 2 to 3 weeks,
Right.
partly on the basis of things like this. So let's see. It's actually also unusual to see kind of dollar and gold rising at the same time. So
Yeah. Yeah.
something is going to change, I think.
The other kind of trend or interesting talking point that I've been seeing is the idea of the United States adopting a sovereign wealth fund and investing into those types of technologies that you were speaking about, quantum computing,
Yeah,
AI, obviously being involved in that. And Richard Duncan is an economist that is actually in Thailand, but he focuses on the United States, and I think does a very good job of keeping a very objective view. And he has written many books that I also have read. And his books are, he was pushing for this type of investment. And if you need to create productivity in a country, this is one way to do that. So it'd be very interesting to watch to see if that catches wind and if that actually spurs additional growth. And
yeah.
obviously, Dalio talking about that on a regular basis too.
Yeah, and a lot of countries around the world have done that very successfully. And there's no absolutely, I mean, the UK is also talking about it. The UK missed a massive opportunity to do that in the 80s when it sort of had North Sea oil, and could have put kind of royalties from that into a fund, which would now be worth, probably £2 trillion. And they would have no kind of trouble funding infrastructure and other things that would make the economy more productive and so on. I mean, it's just a total missed opportunity. You do get that in a few places in the US. So, for example, Alaska has a sovereign, well, it's not a sovereign wealth fund, but a state wealth fund, which issues a dividend to every Alaskan citizen from birth, I understand. So there are different things you can do with pools of capital like this if they're kind of created at the right time and done properly.
Absolutely.
Unfortunately, politicians often not kind of very long term in their thinking.
Agreed. Well, like I mentioned, we're coming up on time, and I want to get to a few more questions. But I have, and I'll ask you this, not live, but off the record, because we would definitely love for you to come back and discuss one of my favorite laws that I was able to learn through your work, the law of the economic rent. And obviously, that put me on Fred Harrison, put me on Don Riley,
Yep.
taking for a ride and understanding all of that. So we would love to get into that, as well as the recent piece that PSE put out in regards to the presidential cycle and the relationship to the real estate cycle. However, we just don't have the time to do that today. So we'll hopefully get Akhil back for a part 2 to also talk about the jobs report and 2000. And by the way, the jobs report will be out for October at that time. So I'm looking at September's numbers right now, and
Right.
the relationship of the current real estate market versus the 2008 crash. But we were on a great roll. I did not want to stop talking about that. But there are a few questions that have come up that I want to make sure that we do address in the next 3 to 4 minutes. So I don't have a ton of time. That being said, one question I haven't heard asked to you is what do you believe the most misunderstood aspect of the economic cycle really is? Because that is something that is interesting to me, and I thought it was a great question.
Yeah, I saw that question. You thankfully sent a few of the questions in advance. To be honest, I find that quite hard to answer because I live and I've immersed myself in it, and
Sure.
I speak to subscribers some of whom have sort of become, they believe it too. They believe what I write, and so I don't know what they don't understand because they seem to understand it. If you see what I mean. I'd probably say there's two things. The first is that the cycle is stable because it's based on things like the law of economic rent.
Mm.
And I think, I actually put something else on X this morning because it just was National Cat Day, I think, yesterday in the US. And, one of the phrases that we use about the cycle and understanding how it works is once you see it, you can't unsee it. And there's this image of this cat in a tree, and you normally just see the tree, but if you look closely, you see the outline of the cat. And once you see the outline of the cat, every time you look at that image again, you can't unsee it. There's no going back. And I think, in that vein, sort of understanding how land is fundamental to the dynamics of the economy. I think once you see that, you don't unsee it. And so even we talk about a real estate cycle, but real estate is misleading because we're not talking about buildings on land. We're actually talking about the land itself. When prices rise, it's the price of land that's going up, not the price of the building. In fact, if anything, the price of the building is going down because bits fall off and need repainting and all that kind of stuff. And the second thing is that on top of that, people get very exercised about kind of money printing and what's going on in the credit markets and so on. But you need to link that back to what's happening in the land market, because most of what money is printed for is in some way related to acquiring or putting a floor under pieces of land. And when I say that, I mean price of land. And so, when you had these enormous bailouts of banks in 2008, it's because their balance sheets were in trouble, and the reason why their balance sheets were in trouble is because of the collapse in value of the collateral, often which was linked to the land. Similarly, in the COVID mid-cycle kind of recession, we had sort of furlough schemes and paying people to be off work for an amount of time. What was most of that going to? It was actually, for a lot of young people, it was to pay their rent or for people to service their mortgages. It's that's the biggest item in a household budget, unless you are lucky enough to have an unencumbered property. And so that is, again, it's linked in some ways to, in many ways to the price of land. All this sort of money printing that governments do, it's usually to bail out banks, and a lot of what banks do is to lend to real estate. So it's all linked. And I think, people who are new to the cycle can't see the way in which those things are linked.
Great response. This is a sort of a fun one from a live listener. Would you bet a pint of Guinness that whoever wins this election, the winning party is not likely to win the next election by virtue of where we're likely to be in the cycle at that time?
Yeah, well, so I'd take the bet that they wouldn't be in power. So if you're willing to take the opposite side of that, then yes. Otherwise, bets off. But I mean, the reality is that voters in any democracy punish an incumbent government if they're in a recession, and particularly a very significant one. And so yeah, they want to change. So I would expect that if the cycle repeats on time, as I think it will, the 28 election will take place in very different circumstances. Now, the only way that might save the party in power is if the crisis and crash happens so quickly that they have enough time to enact some kind of stimulus that, for whatever reason, works so well that things are looking up again by the time November 2028 comes around. But that would be a very slim window of time to make that happen if things repeat as I think they will. And the other possibility, I suppose, is if for whatever reason the land market peaks in 2026, but you do get speculative activity that continue a bit longer in certain things like the stock market or in the commercial real estate market, and you have maybe what appears to be a delayed end to the cycle. And something similar to that happened in the 1920s. So the land market peaked in 1926, at least in residential kind of land market. But there was so much kind of pent up demand and so much speculative activity that the stock market and some commercial real estate offices in Manhattan, that sort of thing, went on for a bit longer, for another couple of years. And I don't know if the incumbent party won the 1928 general election, but maybe you might get something like that. But then the one after that will then be, obviously very significant in terms of a change.
Well, great response. Regardless, I would love to have a pint of Guinness with you. We would have a great conversation.
We certainly would.
Thank you so much, Akhil, for your time today. Again, if you want to go check out the book in detail and Property Share Market Economics, here is the link to do so. I highly recommend this. And I don't point people in a lot of directions because Frankly, many people and many groups are trying to get you to believe a certain way so that you purchase something. And I have not seen that from property share economics whatsoever. So highly recommend the book, The Secret Wealth Advantage, as well as the subscriber list over at PSE. And we'll get all of those links for everyone in our follow-up. All right. So Akhil, thank you so much again for your time. And I will be badgering you, Katie and I will be badgering you to definitely come on for part 2 on the law of economic rent and a few other determining factors of where we're at in the cycle. Today, we actually have a meetup group here in a few hours. So please do come out to Overland Park, Kansas from 3 to 6 to meet us. And we'll pick that back up in January of next year. We'll let the holidays happen and we'll be back to doing our regular multifamily meetup group in January. I am speaking at this event, the AEC and Commercial Real Estate Outlook here in Kansas City on Wednesday, November 13th from 4 to 6. So if you're around, would love to have you come and discuss commercial real estate. And lastly, but not leastly, we have our holiday kickoff event of contractors, closers, and connections. It's going to be a blowout party, and there's going to be well attended with a lot of commercial real estate professionals. So make sure to check that out on December 5th. And if you're interested in learning more about commercial real estate, how the economic cycle can really give you insight in what to do with your properties and position your portfolio accordingly, you know how to reach out to me. That's Logan at XChangeCRE.com, or just head over to our website. So once again, Akhil, I just want to say thank you. I have actually, if you were to go back and listen to 3 or 4 of the episodes previously, I mentioned your all's work on a regular basis and say, we're going to get him on the show. And this was highly anticipated. We have so much more that we hopefully will be able to get into, but thank you for your time. We very much appreciate it.
Thank you so much for having me. It's really been really excellent, and I'm happy to come on again.
Fantastic. Well, thank you all for joining the Commercial Real Estate Market Pulse hosted by Exchange Commercial Real Estate here in Kansas City. We'll see you in a couple weeks.